All right. Hello. Welcome, everybody. And there he is, right on time as I press the live button. Matt Money with me, Arnie with me. This is the Palantir Weekly, episode number 87 edition before Q2 2023 earnings. Are you guys excited?
We'll see. No, I'm just kidding. I'm pretty excited.
Yeah, I'm pretty excited. Even though, obviously, if we're long, which most of us here are watching are long, Q2 is just the check-in. It doesn't matter in terms of the trajectory of the overall business for the next decade, but it is one of the most anticipated earnings given the stock has run up 200% this year. Last time we had earnings, the stock was at $7.42. After that earnings, the stock closes at $18.06 the last trading day before earnings. So this is going to be a really interesting earnings just to see if we can justify this valuation and if we can keep things going. And speaking of valuations, I want to start the conversation here, and then we'll get into the actual earnings stuff. Thank you, everybody, for being here in the chat. Arnie and I had a Spaces on Twitter, now known as X, a couple of days ago. And the point of the Spaces was to critically examine the Dan Ives $25 price target that Matt and I talked extensively about last week. And essentially, talk about the valuation model. We thought that Dan had a pretty good understanding of Palantir from a, qualitative perspective, but the idea that they would be worth $62.5 billion, it was kind of just like, how did he get to that point? And so we had about an hour-long Spaces talking about this. It was a good discussion. Dan blocked Arnie because Arnie called him out on the valuation a day before the Spaces. And then he unblocked him, and his justification was, I didn't want 50 negative tweets every 10 minutes, which is fair. I mean, like, the dude has a lot of followers. He just doesn't want all that noise. That makes sense. Arnie says, okay, no harm. Would love to have a chat. Dan says, sure. After tech earnings, we can do a Spaces. And then you says, thanks for the opportunity. Can't wait. Dan says, be fun and good to speak. I also quote tweeted this and like basically said, this is confirmed. And Dan responded underneath that quote tweet, essentially saying it's confirmed. So I think it'll be very weird if he flakes on this. It seems like he wants to do this and he's excited to engage with retail. So Arnie, I want to start off with you. You're the guy who got the job done in terms of getting people to respond. You get Chamath, that billionaire, to respond. You get Dan. You have a knack to get people to respond. What are you excited about for this conversation with Dan, and what is the goal of the Spaces in your opinion?
Well, I would say, given the context, I think it is very nice, very important. The signal is not much about the valuation being right or wrong. I think the signal very strong here is institutionals were sleeping. Now people are waking up. These have implications also for all what we do, not only in terms of visibility directly for us. Obviously, we have an interest in Palantir to become more mainstream, but also in terms of understanding. While I criticized the quantitative aspects of this report, this report was actually very good in grasping the essence that this company is not a consultancy, is not a company that requires SPACs to to keep growing, otherwise they're unable to do anything. They are an AI company perfectly set to grasp this wave. So with the conversation, well, I'd like to challenge a little bit in terms of valuation, because that's actually my only worry on the company. Let's say, if all the worries are always like this, it's fine. But I think if we go back in the past, like 5-6 months ago, neither too much, we had a lot of conviction, but there were also doubts on, okay, but this company is powerful. Why things are not unlocking? Why we don't have any signal that Palantir is recognized for what it is? Is the management so bad that they're not able neither to sell what they do to the broad world? And now we saw the world literally flipping. So from being hated or ignored, now it's like Daniel said, it's the game of the town. When you call clients, they say, we want Palantir. That's a positive signal, very positive signal. But as investors, we need to be aware that is always a game against probabilities. There is the reality, which is the underlying company with its fundamentals, the business that unfolds. And then there's the price, which is the object that incorporates all the assumptions, the expectations related to that reality. And when the price moves too fast compared with the underlying reality, that is where you have the risk increasing. The opposite of what it was months ago, where basically the reality was unfolding slower than it was doing at the beginning at DPO, but the perception of that reality was so bad that it gave a huge margin of safety, which was why personally I was very invested in it. And why now I'm on the other side, I'm way more cautious also in terms of portfolio allocations, because right now I don't see probabilities going in my favor. This doesn't mean that we can go further, but I just think probabilities are not in our favor. So with Dan, I would love to discuss more on the quantitative sides of the matter, because Palantir is already trading at a rich valuation at around 18, 20x EV sales, depends on what sales you use. And his proposition was, okay, Palantir is the messy of AI, it deserves to trade at $25. And say, okay, great, I love strong opinions. What I don't love is strong opinions not backed by any reason. And his reason was, we plug a 10x multiple on 2027 revenues, and voila, $25 per share. So why not 50x EV sales on 2050 revenues? Why not?
Right. Matt, what were your thoughts on two retail investors getting Dan's attention and being able to talk to him? And what would you like for us to talk to him about on that Spaces?
Well, first, I want to hear if he was strategic in his timing, as you've always been wondering a bit for Dan Ives. No, I'm just kidding. But I do think that the reason why Arnie gets so much attention is, one, his good looks, and two, his beautiful accent, and thirdly, how great and eloquently he speaks about the company. So always, Arnie, congratulations, and keep doing what you're doing. You're a gem for the community, and I mean that in all sincerity. I do echo a lot of the same sentiment that Arnie has with respect to what's going on. I think he said it beautifully when he was saying, "Are you evaluating the company on a multiple or 2050 sort of earnings?" And I think, in all honesty, the company, as Arnie kind of alluded to, is really trading, if you were to look at it on a revenue and earnings of fiscal year 2026. So I think in reality, it's trading probably at about 2.5 times more than it should right now. And I think that's initially going to give some folks, well, maybe not anymore because it's pulled back, 10% over the past day or two. But I think at the $20 valuation, I think that's pretty richly valued in the short term. It's not to say, and I guess this is always the battle that people are always having, are we actually going to meet those sort of criteria in fiscal year 26, right? Even if people are comfortable with that and, okay with a $20 price target with what we see, are they okay with that? Or are they more so thinking about, hey, the revenues and stuff that we're actually going to be getting in fiscal year 26 are going to be accelerated into 2024. And that's why everyone's kind of started to pile into the organization. What I do think that Arnie is truly right about, we agree on a lot. I think the thing that I agree with him most on is you are starting to see that sentiment of the Billionaire Boys Club, as I talked about last week, really change. And I think a lot of folks are becoming bullish, but I also see some of that, some of the people that previously were bullish as well step away. And I think it comes back to the fact that Palantir is a very powerful organization that truly wants to partner with you. And some people want to be partnered with, and some people want to be left alone. We've seen the instances of when Palantir gets into organizations, they realize the power and efficiencies, and sometimes the poop gets pulled out from the filing cabinet. And I don't think sometimes some of these CEOs like that, or some of these organizations like that. So very quickly, you'll see Palantir come in and Palantir go back out. And I think a lot of that has to do with the fact that it's such a good tool and it organizes things in such a good manner. But I honestly still think that people just assume that Palantir is just like this database company that you just search up stuff. And in reality, I think it's much more than that. I think that I've been doing a lot of thinking, and I don't want to dive deep into this because, Amit, I know you're kind of the lead and you have a lot of questions and where you want to go with this, but I see huge implications, right? And I'm not just blowing smoke. I'm seeing the continued implications in healthcare, the potential for education, and not just from a healthcare provider to patient, but a patient to healthcare provider implications as well. Being able to store personal consumer data and allowing people to agree that yes, I will share this information with this new healthcare provider. Say you go from a vision doctor to a normal pediatrician or a physician, and you say, okay, this is a new physician. Yes, I'll go into Palantir and use the Apollo program to allow that security to kind of come through. I think that everyone is thinking at this point, Palantir is very much still B2B or assisting other companies. But in reality, I'm starting to truly think about the opposite of where Palantir is probably going to go from government, because that's the easiest thing to kind of do, and that's have very steady revenues, to corporate, and eventually get to the point where they will get to the individual consumer. And so I think that just continues to open up more and more TAM. But anyway, I don't want to go too much into a tangent about what my crazy mind has been thinking about, considering we're talking about 2Q earnings here. But Amit, I also want to admit that your opening statement was 100% false. No, I'm just kidding. We still have Monday to trade before the earnings, so don't get ahead of yourself. You said it's the last day.
That's true. We do have Monday to trade. Okay. Arnie, I know you have a chart you want to show. So let me share Matt's tweet real quick. And then Arnie, I'm going to show your chart because we're just going to get straight into earnings expectations. And Arnie, I'm sure this chart is going to matter a lot when we talk about valuation. So Matt, let's have you start this off. This is what you said for 2Q 2023 earnings predictions. Matt says revenue of $550 million, 16% year-over-year growth. U.S. commercial surpasses $125 million a quarter. Adjusted cash flow from operations. Yep. Oh, there we go. I got it. Of 180 million. Cash surpasses 3 billion. Interesting. I didn't think of this one at all. Customers 441, up from 308 and 391 in first quarter, up 43% year over year and 13% quarter over quarter. That 43% year over year growth is amazing. And commercial customers surpasses 310, up from 280. Any justification behind these numbers? And then after you go, Arnie, I want to get your thoughts on these numbers, and then I'll share your chart.
The easiest one to talk about is the customer count. So I think if you looked at 1Q 22 versus 1Q 23, I think it was up over 40%. So it's not too much of a difference. I'm anticipating that you'll get some new clientele on with the use of AIP and the kind of the enthusiasm around that, and how that people can kind of truly start to embed AI in a very systematic manner into their organizations. What the thing that I mostly was thinking about was the commercial customers surpassing 310. I think that was like about 10 or 15% quarter over quarter growth. I'd love to see that, but that's not too dissimilar to what we've been seeing. We've been seeing anywhere between 12 to 14% every quarter, kind of on a very steady pace. And so my hope is that we continue with that. How I came up with the revenue was, as you can see, it's still only 16%. I anticipated about a 5% revenue growth in Europe, or I guess non-US revenue. And
is there any reason for that, or you kind of just think international?
I still don't. We still haven't fully unlocked the NHS deal. There, we did knock out the Ukraine deal, but I don't think money's going to be showing up for that as of yet. I think that you still have some time for that. So I haven't really seen too much from a European perspective of impacts this quarter, right? Something that was started a year or so ago that would really have a huge fundamental change. Maybe you start to see some sort of Ukraine revenues kind of coming through that, because you think about it now, I mean, they've been helping Ukraine now for just under 18 months. 18 months, maybe it starts to show up, but I don't know if we're still offering that technology for free, or if we're using it as a battle tester and partnering with the Ukraine to kind of say, okay, this is more of a NATO specific military application that we'd like to develop, so we don't mind working for free with Ukraine because it'll battle test it. That I don't know, right? You could end up seeing something where it's especially now that the United States is giving billions of dollars in terms of aid. Maybe they're helping pay for some of the Palantir bills. I don't know. But the rest of it, I continue to see more and more people doubling down in the U.S., specifically the commercial and the government as well. I mean, you saw, and I think you labeled it in one of your tweets, Amit, where we had several U.S. Army contracts go through, and those are all very shorter term, like 2-3 year contracts. So that should start hitting the increases or keep up the net dollar retention for the company.
And you think that will help us beat the 532 that they told us to expect? You've got them at 18 million.
550. Yeah.
550.
I know it's bullish, right? This is kind of more of an upper edge, I would say. I really wanted to just be like, okay, that makes sense. But what they were going for was a 12% year over year. It was at 473 last year in 2Q. 12% would have been, just under 50 or just over $50 million more than that. So that gets you to the high 520s, low 530s, just like they forecasted, right? Yeah. I think they forecasted the upper range of 532. And I just like, you know what, man, like I really, maybe it's more of a hope and a prayer than anything, but I'm just very confident that they've seen some things come through that I think they were hedging for that will start to pay dividends. And if you think about it, $18 million in terms of a 4-quarter run rate is less than $60 million annually. It's really not too big of or I guess it's $72 million. I'm not good with math. You guys know that. $72 million annually. It's not too big of a pump up in terms of, annualized revenue numbers, right? But, I think, I don't think when they released 1Q, they maybe had finalized the release date of AIPCon as of yet. I know that they were kind of like teasing it to an extent because it is in the presentation.
So, they're also, we got to assume they're sandbagging, like at some level, we got to assume.
Yeah, I mean, I think that's the hope. But anyway, I've been talking for too long. I will say though, I'm not going to be surprised if they come in at 530, just like they forecasted. But my hope is that they were sandbagging just a little bit. And to be fair, I think where I care more about is the customer count. So if the customer count appreciates at over 50% year over year, I think that's more important than seeing the revenue growth go to 550 for the quarter.
100%.
But I think that we need to get closer to a $2.3 billion fiscal year 23 to truly get back towards where we need to be. And I'm hoping we don't go to the 2.23 or something that I think we're forecasting. But I think the $3 billion is very easy. I think that we continue to add about $100 million a quarter. I don't think that's very unfeasible. What the hell they're going to do with that $3 billion is beyond me. But I'll kick it back to you guys because I've been chatting for too long.
Okay, Arnie, your thoughts on earnings predictions, and then take us through some of the thoughts you have about valuation right now.
I'm very aligned with all what Matt said, but just to make one step back to what we were discussing before, here is the chart where we can see the relationship between the fundamental metrics with which SaaS companies like Palantir, Snowflake are usually valued. So a combination of revenue growth and free cash flow margin that compared with the valuation. And when I made this chart was at the beginning of the week, Palantir touched $20. Basically trading at almost 20x EV sales. And we can see the relationship, how Palantir relates to all the other companies with similar metrics. Right now, Palantir grows neither 20% in terms of revenues, and it has a free cash flow margin of around 20%. And the management said we expect to keep the rule of 40, that's how the combination of these two metrics is called, around 40%, meaning that the management said last quarter, we will stay at least at 40% in terms of 20% growth, 20% margin as combined. That's the gross idea. So this also supports the fact that probably the guidance they gave of 13%, 12% is actually a very low guidance. Also because historically they exceeded that guidance by 3%. Just to jump a little bit to this other chart, here you can see basically the revenues, the comparison between the guided and the actual numbers. usually there is that 3% more they give every quarter. They gave now 13% guidance, so it is reasonable to expect that the number should be closer to 16%. But even if it is 20%, that is actually great. The problem is in the valuation. Unless the management gives clear signs that even that potential 20% is actually low compared with the real fundamentals unlocking of the company. So the story. The problem is when the valuation is already this high, you require a lot of growth to justify your valuation. Snowflake is here having the highest valuation in terms of software companies, mainly because it has very, very strong growth. Here, this almost 80% comes from a combination of revenue growth around 50% and around 30% free cash flow margin, more or less. The problem with Palantir is that it has a great free cash flow margin and the growth actually sucks.
So,
if you look at it purely from a fundamental standpoint, paying 20x revenues or so for a company growing 15%, that's laughable. But that's the story unchanging. That's the story changing. The story unfolding, I would say. So we need to remember that while it is important to have a sense of how good the numbers are for the quarter, what the market really cares about is not the beat on the quarterly number, but the outlook that the management is able to share, because that drives the future growth. So my personal expectation is not very detached from what we just discussed, probably something around 16-20%. But I would say that's neither the most important thing. The most important thing is the number of clients keep increasing, hopefully with the highest quality possible, but a clear direction that what was just a dream months ago with Carp last year, as we discussed also during the spaces. Carp said in 2022, we will hit 4.5 billion in 2025. And to get that, you need way more than 30% growth. You need like a 30% growth. With a 30% growth, if you are able to give confidence to the market that you are going to achieve that, not only for 1 year, 2 years, but on a consistent basis, there is where you can justify a high valuation.
Yep.
So I would say here is not only a matter of the numbers that come out, is a lot in terms of how the management is able to share their confidence into the future. Are there any basis for that? Because otherwise, the market, and we will see also with analysts, they will still be anchored to the crappy things. Consultancy, there is an analyst who reiterated it's $5 per share. Frankly, I hope he's right, underscoring the SPACs. And SPACs are still there, like basically almost all failed. This has an impact on the revenues, obviously, because SPACs were actually a nice contributor to the growth. They were small, but the revenues compared with the size was actually high. It was around 8-10 million per quarter, or no, per year, per each SPAC. So having almost all the SPACs failing, that inevitably impacts the revenue. But again, if, let's say, all SPACs die, but the management is confident in sharing, look, okay, let's move on. The clients we acquired outside SPACs are able to grow consistently and match. Who cares about SPAC? For instance, you see that Ives neither mentioned the word SPAC, neither one time. While for other analysts, SPACs is all what matters. Obviously, that's a bear argument, and you see also the bear cave hitting at that. But frankly, I would say at this point, the revenues were collected, the R&D was done. It's like if you make one bad trade as an investor, does it mean that you are a stupid investor for the rest of your life? No, you accept what you did, the good and the right, and you go on. I think that's the case.
Yep, I agree. Colin, I see your super chat. I'm going to get to it in a second because I think it's a really interesting question, but I want to end off the earnings prediction segment of this with this question. I want the chat to participate, and then you and Matt, you probably got to take a minute to think of this. I want you to give me one dream scenario for Q2, meaning like if one metric in which you assume, oh my goodness, they did it, and it blows you out of the water. And then I want you to assume the opposite of that. So two things. The opposite is one thing that could go to shit. The caveat is you have to have a logical reasoning for that. So here are some of the metrics: customer count, GAAP operating margin, cash from operations, adjusted free cash flow, revenue, U.S. commercial, U.S. customer count, GAAP profitability. Think of some of the main metrics we're all looking at, and think of one dream scenario that they just hit it out of the park, but some logic behind that, kind of like Matt was saying with international growth. And then one metric where they shit the bed, but also logically why they might be able to shit the bed on one of those metrics. I'm going to go first, so I'll set it up and then you guys can go. I think my dream scenario is customer count, and they hit it out of the park. I'm not going to give a specific number, but let's just say they hit it out of the park. And my logic is AIPCon 2 is in September. So the type of logic I'm justifying for... can you guys hear me? Yeah, we're still good, right? Yes, we're good. Okay. So the type of logic I'm giving for why they hit customer count out of the park is because they're having a second conference with AIP. So that second conference, I'm assuming, means they're not just doing it for marketing. They have a lot of customers, even if they're not getting the revenue from it yet, that have signed on to this AIP platform. Plus, I'm putting the dots with Dan Ives talking about talking to all the CIOs. They're saying Palantir is the big thing. Carp saying we have more demand in 12 months, blah, 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 blah. So customer count hit out of the park. That's my biggest metric that goes up and does really well. My shit the bed metric, honestly, might be stock-based compensation because they are hiring more people. They do have to start paying more for sales and marketing. More logically, stock-based compensation should keep going down, but I think Q1, it made sense for us to go down from Q4. Q2, it should tick up a little bit if we're seeing a little bit more hiring and a little bit more sales and actually getting more deals done. And so stock-based compensation might go up. Not aggressively, but it might go up to the point where it's a little annoying. Hopefully still keeping that 27% decline year over year. So my dream scenario, customer count goes through the roof and the market's like, holy shit, AIP is real. Shit the bed scenario, stock-based compensation goes up a little bit too much and it's a little bit annoying. Matt or Arnie, who wants to go second?
Well, let me touch what you just said, because that was something I wanted to underscore. So far, we have been seeing the stock-based compensation declining, and this was one of the most exciting things to gradually track, because especially in this December, the market started having a allergy. They couldn't touch anything that has stock-based compensation around the year. But the reality was, okay, that's a risk factor, that's a negative thing, but if you incorporate into the valuation, and the valuation makes sense even without you, if you consider the headwind, that's fine. And the most important thing is these numbers to gradually go down, because this means not only it is good in terms of perception, but that is what allowed Palantir to become not only operating profitable on our operating side in terms of free cash flow, but also in terms of GAAP basis. And we know how much the market wants that. However, there is this sentence that I think is important to mention. Q1, the CFO, while we expect to see stock-based compensation expense trend up through the remainder of the year, we remain focused on GAAP net income and operating profitability.
So they're expecting it.
So they already said, okay, probably it will be not 115, probably 115 will be the kind of a bottom. But even if SBC trends up a little bit, they want to stay GAAP profitable. Right. Which means that right now the stock-based compensation has around 20-24% impact on revenues. If they want to stay GAAP profitable, it means that that's the most stock-based compensation can hit, because otherwise you don't get the profitability from a numerical standpoint. So that's the negative side of what you just shared. In terms of the metrics I'm following, sorry, let me again. I insist that every time, this is the most important metric, because if the number of customers explodes, now we are focusing more on the commercial side. We know the government is slower, and the big bet in terms of growth is on the commercial side. The government side is more, you need to keep your dominance. Here is the big bet. And so far, the number of clients is growing well, but naturally, as this number increases, it is also harder to keep that percentage growth steady, because with a bigger base, growing 2x 50% is very hard. But this is exactly why this would be the dream metric, because in the last quarters we saw the growth staying around 50%. The comparison is tough because here in 2021 we had the SPAC explosion that helped the US commercial count client commercial count increase, and now we are making the comparison without having the SPACs. So this number is impacted negatively by having SPACs who left. So in Q2 we will see SPACs disappearing. And this is exactly why, if here, rather than a plus 50% increase in the customer count, we see a number like 100% because the number of clients from the US explodes, that would be the biggest possible hint. If that happens, I neither care if revenue grows by 13%. But at the same time, since this metric is the most important thing, that's also my shit on the bed metric.
Yeah.
Because if we see this metric decreasing very much, that is potentially a warning sign. While it's not necessarily a warning sign, because when AIP was shared, it was May,
yeah.
Time to make the demos, time to make the event. The events were in May or June. So it takes time, and even if they have unprecedented demand, maybe they are all on the pilot phase. So
right,
as every number, we need to understand why a number is high or low. But I would say, given the importance this metric has, we need to understand what's the dynamic inside here. If the number explodes, good, there is no question marks. Things are definitely working well, and with that, I neither care if, I would pay zero attention to the revenues if this number explodes. But if it doesn't, we really need to understand, okay, what VF is going on, because that could be an okay sign or could be a very warning sign.
Yeah, makes sense. Matt, any dream scenarios and any things that might go really bad?
Yeah, so I hate to beat a dead horse, but I agree. I wasn't thinking about the commercial specific side, so I appreciate Arnie bringing that to light. I was thinking more just along the total customer count, being about 475, which would make, year over year, I think my forecast was about a 42% or something like that, at growing to 440 or so clients, up from 308. Going to 475 would make it about 50% for the entire customer client base. And so that's kind of where I was thinking in terms of that. And the reason being is, and I'll do a brief talk. I won't talk too much about it, and then I'll get to where I think we're most at risk is, or that would be very surprising for me on a downside. I think Apollo, in terms of, while I agree it's a great product, I don't think it's had the amount of hype to the extent of AIP. And my hope is, with additional usage of AIP being more towards the non-technical user within organizations, and it being more of like a ChatGPT sort of usage for enterprise, that you now have the need for more use of Apollo, security rights, allowing people to have different versions and access to different parts of the underlying sort of Foundry workbooks and databases and stuff of the like. So I'm hoping that the continued intermingling of all these different products continues. And what I will say is I think the reception of AIP has gone extremely well so far in terms of AIPCon and the amount of buzz that's kind of happened within the organization from an institutional standpoint and a retail investor standpoint, as well as folks that have seen the demonstrations like myself, CodeStrap, and others. It's reignited kind of my love for what Palantir is truly doing from a software perspective. And so I hope that that kind of kickstarts that customer growth compared to what Apollo has done, which I think very few have really uptook Apollo as much as I'd like to see at this point. And I think it's truly one of their most underutilized products, or actually the most underutilized operating system that Palantir has kind of created thus far. And I hope that that continues to have a longer wavelength, because I think people don't fully understand that applicability yet. Now, moving towards, I think, on the downside, the thing that bothers me the most, which I'm hoping AIP might not necessarily have a huge impact in this quarter, but I hope will ignite the company in the following quarters, is net dollar retention. And I've seen that continue to go from 150% to 130%. Now towards, I think in 1Q or last year when I was doing some looks, it was like below 120, it was like just above 110%. So what I'd love to see is that continue, back towards the up and to the right. And my hope is that with AIP, the continued usage of more non-technical folks in organizations and, all that continued usage of in the background usage and creation of data and all that just allows you to expand and reignite that top 20 client revenue growth that we've kind of seen has always been in the 10 to 15% range, and continue to grow that back towards where we are. And my hope is, just getting back towards everything, kicking it back to the overall revenue growth and hopefully kickstart, and then I'll kick it back to the room, is I think that, and my hope is that they might have used the Apollo sort of rollout and the lack of buzz in terms of what they think might happen with, say, AIP. And my hope is that AIP is a completely different rollout in terms of customer appreciation, growth in the organization, and that basically demonstrates and kickstarts back the revenue comparatively. I think everyone understands that, but I'm hoping that management kind of saw what happened with Apollo, hoping that Apollo would be a much bigger rollout, and then muted kind of what they think the anticipation was for AIP. And I hope that AIP basically blows them out of the water with the reception. And I think that's kind of what Karp has been saying, but fingers crossed. And once again, there was only really 1 month of AIP true rollout in 2Q. And so I think you need a little bit of love between now and then and time before we truly start to see the results show up.
Yeah. Totally agree with that. I think that makes a lot of sense. Net dollar retention is going to be a big one to watch out for. As Crossroads says, it was 111% Q1 2023, and they kind of didn't show it as much as they could have showed it. Let's talk about the super chat. Colin, thank you for this $20 super chat. I think it'll be an interesting discussion. Then after this, we'll talk about Shyam Sankar and some controversy today regarding him. He says, guys, this isn't a typical valuation context. I'm an investment banker who does tech valuations for a living. Palantir is a huge TAM and roadmap to $1 trillion market cap. There is a value based on current metrics plus embedded option value. I'll go first on this, then I'll be quick, and then I'll hit it to you, Arnie, and then Matt. I think we all agree they have a huge TAM, and they definitely have a roadmap to at least maybe 300-400 billion, even if you don't see $1 trillion. But at some point, the numbers have to make sense. And with interest rates at 5.25%, I don't think the market can just say, yep, Palantir $50, Palantir $60, because eventually they'll hit, $45 billion in revenue like a Salesforce or Oracle. Salesforce is on track to do $50 billion by 2026. We've got to prove the numbers. And the one thing about, I think, our community is we have such an amazing understanding of the product and technical stuff, and we're so excited about the future, but we just don't have the damn numbers to back it up yet. Not yet. And so until we get those numbers, I don't know if that whole $1 trillion fantasy valuation we're all thinking of is possible. And I know that's what you have to believe in as a long-term investor, but at some point, the numbers have to justify. Tesla had to eventually grow 50% year over year to get to be justified where they are. Arnie, what are your thoughts on that super chat?
Well, I have to start from the premise that this is a top-down analysis and not a bottom-up one. What I mean with that is when you try to make a valuation starting from the TAM, you start from the end goal, and you try to investigate how much of that market the company is going to acquire. So you have two assumptions. How big is the market? The second is how much of the market you're going to take. Not different from what Peter Thiel said. The most important thing is not how big is your market, but if the market is X, how much Y or that X you're going to capture. And that's where the monopoly question really starts to hit, because if you are in a big market, but you're not able to capture that, you end up being a loser. While monopolies tend to get that Y, so that percentage of the market, and that keeps increasing. For Palantir, we know that the TAM is not big, but it is immense because we can see the stats from AI platform hitting more than $800 billion. Palantir right now has $2 billion. So it's still a small fish in the big ocean. Also, in terms of government spending for SaaS, a couple of weeks ago, I shared a tweet from a guy who has a website sharing the details, and it turns out that Palantir has around 10% of the SaaS government spending. So that is a good hint that in terms of ability to capture that market, Palantir is actually good. And we know from having studied the company that the SaaS TAM in the government is still relatively small compared with its potential and how important it is becoming both on the non-defense side, but also in the defense side. The DoD shared an intention of we will go on cloud heavily with joint with JD2 and so on. So turning back to numbers, the TAM here is 800 billion. Let's round to 1 trillion, the famous 1 trillion. If Palantir is able to capture, let's say 10% of that, that's already a monopoly style. A 10% of 1 trillion is 100 billion. And 100 billion is not impossible. The problem is to get there and to have your share increase, you need to grow much more because this pie is growing like 30%, 20-30% CAGR, expected to grow. If Palantir grows 20%, it means that the share they're getting, this is not going to be much. Actually, it would mean Palantir is losing market share. So in order to capture that 10% of the 1 trillion pie, you need to grow much faster than the market. Otherwise, you don't get there. So very hard to make a reasonable valuation with that, because when you start from the TAM, you're basically doing a Cathie Wood analysis, which could be directionally right in terms of the essence, but I think 5 times out of 6, you end up having a crazy price target because you say, oh, the market is growing 30%, oh, Palantir is going to get 10% of that, and say, okay, that's a very bold assumption. So
yep.
I don't like top-down analysis. I think they always tend to overestimate the things. One anecdotal thing you can see is typically you see crap companies overselling themselves by putting the TAM slide as the first and putting that as a reason why to invest in the company. That's a typical sign of a company I don't want to have. I prefer the bottom-up analysis because with that you can have a better sense of, okay, how good are the conditions that allow this company to actually grow more than the market. As we mentioned before, becoming a monopoly, it's all about having a size that keep increasing and you keep acquiring a bigger piece of the pie. To get that, it means the market grows 20%, you go 30%. Focusing on that, in my opinion, is 100 times more effective. And if you look at the valuation from, okay, how much the company is growing right now, what's the current multiple based on this growth? Is this growth set to keep growing or accelerate? Then you adjust the number. Remember, whatever valuation you do, under the same assumptions, you get the same number. So the valuation you use in terms of method is only a tool, a way you try to look at it. Obviously, there are valuation methods that for the kind of company make more or less sense. For instance, in biotech, let's say Upseller, since now I saw many people talking about it, they have no revenues. You need to talk more about what's the potential end market in 2030, what's the percentage they try to achieve. With a company like Palantir already having significant metrics, now even GAAP profitable, I would focus on that rather than a top-down analysis.
Yeah, I agree. And Sachin's comment here is really good as well. Government sector is dominated by 3 to 4 companies. If they get 90% of the market, Palantir should do well to reach 20% of the government spend, especially defense revenue, in my opinion. Matt, your thoughts on a potential use of the TAM to justify a overvaluation of the stock?
I mean, that's what everyone always does, right? I mean, I think it's always when you have these large growth companies, or not large growth companies, just growth companies that come onto the scene that are kind of battling these new untested waters. You'll always kind of have this push and shove about what is the actual valuation and how rich is it versus what's the total potential, right? Just like how Tesla was worth $50 billion back in 2018, 2019, before they really even started churning out any real profit, right? People were valuing them bigger than GM and Ford, and people were sitting there scratching their heads being like, I don't get it, right? Now we see where they're at with a close to 1 trillion market cap, right? So I think, it's in a similar fashion. And I think I like to think of it very similar to Arnie, except I think about it as, 1 trillion for AI, however many hundreds of billions for data analytics, data management. You start to add all these TAMs together, and you're probably closer to the 2 trillion mark. What percentage are you going to capture of that? And then you start to look at, and this is why the stocks are always so volatile. You'll have the people that are saying, well, it's going to be able to grow to whatever sort of revenue a year, and then it misses and aims low on guidance, and then it gets smacked 20% in a day. And then you have okay, well, let's value it closer towards what it can create in the next 2 years. And then you get to this point where it's like, oh crap, revenue reaccelerated again. It's always that oscillation period and that volatility, that whiplashness that we always see in a lot of growth like companies, right? So I think both matter, and there's always a tug of war between the two. And I'm with Arnie with the extent of thinking about it. If you're a $2 trillion TAM across a multitude of sectors or addressable markets rather, and you're able to get 2% or 3% of that, then you're looking at a pretty healthy amount of revenue kind of coming in, 40, 50, $60 billion. And if you're able to get a cash flow margin, as we've kind of seen over the past few quarters, of 30 to 40%, then you're going to be able to start churning out $15 to $25 billion worth of net income and cash flow from operations. And if you multiply that at a reasonable valuation, you're going to start getting to several $100 billion market cap. Now, the thing is how long is it going to take you to get there? Are they going to continue to hold that market share? Are they slowing down? And that's always that tug of war, right? So you can always start with the end in mind, but at the end of the day, you still have, say, 10, 15 years before it truly gets to that point. Or I guess most of the time they're talking about the 2030 TAM, right? So, it's always going to change, right? You're always moving the dot forward just a little bit every single quarter, but that timeline doesn't change, right? And eventually they'll get to the 2035 number, and then people will reevaluate where that TAM goes and, all that. But I don't think it's wrong. I just think it's another way to look at it. Just like how some people might look at a stock based off of technicals. It doesn't mean it's necessarily wrong. It's just somebody else's perspective.
Yeah, it's really interesting. Real quick, then I'll let you go, Arnie. Colin, if you definitely want to come on the podcast one day, let us know, because you're talking about how you think of it much differently as an investment banker. The contrary side is, I know another investment banker who I did a full DCF with for an hour and a half on YouTube in January 2022. He called me during the week saying there's no way in hell he could justify this valuation. So it's like, on your side of the investment banking world, I don't know what bank you work for or whatever, you're like, oh no, the TAM, that's how we justify, what is it, $40 billion, 20 times price of sales. And then the other guy I know that's a pretty smart dude. I mean, he's working for a pretty exclusive boutique bank. I can't name what it is, but he's just like, I cannot justify $20. He just doesn't see it. And so I guess there are totally different perspectives in terms of how it goes. Arnie, go ahead.
Well, I'll touch a little bit what you just said. We are talking about a growth company, therefore the assumptions heavily impact the evaluation. I remember one of the first podcasts you did with an investment banker was actually showing why the valuation back then was reasonable. So I remember it was around $20, and it seemed, I remember, tell me if I'm wrong, that back then the valuation seemed even undervalued, or at least reasonable. Mm-hmm. Now we are saying the opposite. So you see, the assumptions you put give you an answer that could be even contradictory.
Because he was using 35% year-over-year growth. He was using management's CAGR.
Why 30%? I see.
But management has taken that 30% CAGR out of all the presentations, and that's why he's gone to like, well, now if they're not 30%, I don't know how to justify it, right?
So what you do, you always rely on the number that the management says, or you try to use your own head. In my opinion, as investors, we need to have a very different framework from the investment banking one. I fortunately have both, because when I worked in investment banking, I was on the side of the bank who tries to sell bonds. But the dynamics are exactly the same of when you try to do an IPO for a company. And the kind of analysis could be the same in terms of numbers, but the perspective is very different. Investment bankers basically want to try to sell the product, be that a bond or an equity in terms of IPO, at the highest price. As investors, we need to shift that, and we need to be obsessed with having margin of safety. Why I was able to get Palantir at a good price? Not because I'm smarter, but because when I saw that everyone was forecasting like 30, 40%, 50% growth on some videos on YouTube, while the management was saying 30%, my own assumption was, okay, let's say this growth is 20% because things go shit. Do I have my...
Did he just disappear for you too?
Yeah.
Arnie, your mic went out. You're muted.
Still?
No, you're good. You're good. Go ahead.
Back then, basically the price was implying 40% growth. And I said, okay, but it's a similar situation to what happened in Tesla 2021. The companies keep doing great, but the price was so rich that the implied expectations were so high that basically for you to make a profit, you needed the company to exceed those already extremely high expectations. On the other hand, when I bought Palantir below 10, what I did was I bought a company that was growing like 20%. I paid a price that for that growth was good, if not actually very good. But with embedded options that the growth could be way, way bigger. And if that happens, you have both more growth and also a revaluation of the potential of the company. So while bankers have the incentive to just throw the biggest deal for the customer, so the company, implicitly giving a hit to the acquirers, as investors, we need to be obsessed with, I want growth, but I want free growth. As I said, I paid a company for a price that was reasonable at 20% growth. But if now there are the conditions to get 30% growth, 40% growth, for me, that is all free. And that is how an investor should try to reason, in my opinion.
That is fair. That makes sense. A nice comment by Adam. He says, we already know they're sandbagging because they became GAAP profitable 2 years earlier than guidance For 2 quarters, they beat up expectations. I don't see why they couldn't do it again. And it's a good point. I mean, Karp said August 2022, profitable 2025. All of us were like, what the heck is going on? And they obviously beat that. So maybe this whole 2% quarter over quarter, 16% year over year really is sandbagging to that extent. But Monday is going to reveal if that's the case.
To be fair, the real net income is showing up mostly from the percentage that they're getting from their treasuries and,
that is true.
and their cash, right? And so they're not really making too much money at the moment, just based off the fact that they're giving $100 and some million run rate per quarter on share-based compensation. Now, if share-based compensation goes to zero, the last few quarters would have been GAAP profitable. Yeah. And by last few quarters, I mean probably the last year or so worth of quarters.
Yep.
Because I think they've been running in like the 40 to 70 net income loss for the past few quarters, as opposed to the last two where they've posted the very small, like the one was a $4 million profit, the other was 16 or something like that in terms of net income profit. So if you get rid of that stock-based compensation, you immediately gain $100 million or plus on the net income statement. So that's why you're seeing cash flow from operations being in the $100 to $200 range, and it's doing so well, and they're building cash position. But the share-based compensation piece is what is driving that negative income down. That's why when I look at things, this is why I've been so bullish for the company for so long, is because I mostly look at cash flow from operations. If you're not making any cash in the cash register, because cash flow is is only cash, right? It doesn't take into account non-cash items like share-based compensation or losses from SPACs and stuff like that, right? Because those are all non-cash events. Those are all writing off of, say, goodwill or book value and stuff of the like, and eventually will hit your balance sheets. But anyway, that's mostly why I look from cash flow from operations, because so many games can be played with GAAP net income that I just don't like it. And so I like to see what cash in is coming in and cash is going out. And that's why I like cash flow statements.
Well, cash is what tells you that the business is actually healthy. So the fact that operationally speaking, even including the stock-based compensation, but basically the business of Palantir is able to sustain its business without the need of raising capital. It means that the unit economics of the business actually work well. Now, I think we need to think a little bit in terms of game theory. What if you were Karp? How would you manage the company right now? Because one thing that I keep asking myself is, let's say Palantir is able to squeeze more revenue from the customers right now. You have more free cash flow. Okay, fine. What do you actually do with that free cash flow? Giving it to shareholders doesn't make no sense now. You keep piling up the cash. That is great, helps your business risk-free. So, but at the end of the day, that would not really change the core question of the company. Let's say if you squeeze 10% more from your existing customers, meaning that you have 10% more just for the price increase in terms of revenues. So you have organic growth plus the price increase. Let's say you reach 20%. Does that change to you very much? Okay, you have more free cash flow. But again, what do you do with that free cash flow? I think given the setting, if I were Karp and I think of the most important thing is not to show growth now, but to be sure that in 10 years from now, I solve the monopoly question. And in order to be sure that I solve that monopoly question, I would not give an F to the current revenue growth. I would only focus on we need to unlock the value of our customers. So our customers need to, in 10 years from now, they need to have not 50 million on average. They need to have 200 million per customers, because these existing customers need to have a foundry even when the employee go to the bathroom. If that happens, you don't really care of the current revenue growth in 1 year, 2 years. You only care in 10 years, the existing customers have a foundry full stack in whatever thing they do. Because if that happens, then you have the monopoly unlocked, which gives you the pricing power to basically raise prices 10% every year, and the customer will just say, okay, I have no choice.
And the street will sell it off, which will be the greatest dip for us.
Oh,
right?
yeah.
Because if the revenue is not good, as you're saying, if Carp's intention is to not make revenue growth good, the street's going to be like, all right, screw you guys.
So that's exactly the setting with which I'm trying to look at it. If things go in the normal direction, okay, fine. But there could be a huge opportunity, in my opinion, if we would see the company just growing little in terms of revenues, because we don't know. Like that's the interesting and also the challenging thing, that maybe a 13% growth, 15% growth is actually extremely good, because what Carp is doing is, well, rather than selling you one product for 100, I'll give you 5 products for 150. In terms of growth, that's very little. But if you have that 5 products, that actually help the company grow even faster with its use of Foundry, which means that in 5 years from now, 10 years from now, when basically you are completely reliant on that, then the customer can't move and you can charge him whatever you want. So that could be the case, like as I made last year, where I said that could be the case where the customer count increases and the cost go up, killing the profitability. That would be an opportunity for investors. I see a similar setting, but now with not on the cost as it was last year, because we were starting from 30% growth free cash flow margin that went to 20%. My ideal case right now, that the gap profitability question has been solved, is seeing the revenues growing very little, but the number of customers exploding, having some hints, like with the press releases that we keep having, like West Track last day, after 2 years, a further expansion. If we have the hint that the revenues grow very little, the market hates it, but we have the customer count exploding, basically confirming that the company is de facto dumping the product. They can't give it for free completely because that's illegal, but you can make a good deal for the customer. That to me would be the biggest opportunity, because that would kill the price, but intrinsically we would know that that is the perception that is wrong. It is not the reality. It's not similar, not different from what we saw with Wood. The market focused on one metric that is very important, like the monthly active users. But if you focus on that and you don't grasp the full picture, you would think, okay, Robinhood sucks. But the reality is the company has been doing the right thing. The company has become gap profitable, even in a very adverse situation like Palantir, which means that when the conditions finally align, if you already got profitable in the worst condition, at the good conditions, you start printing money hard. So that's the setting I'm seeing.
Yeah, I hope everyone heard what you just said correctly, because I've been thinking about that for a while. If customer count explodes and revenue declines and the street sells it off, that is when you buy the fucking dip. Because we could have a dip where you're not supposed to buy it because it's not justified to buy it because all the metrics are off and the street actually tanks them for a good reason. Those high frequency trading algorithms care about a couple of metrics. If those tank, you sell it off. But if you're a real investor in Palantir and you know what they're trying to do, you know they're solving problems for industries, they're taking their R&D from one industry to another and then scaling from there, then that scenario Arnie describes, if customer count goes up, revenue declines, is I think a dream scenario for an actual dip that we want to get. Okay, let's talk about this last topic for the day. This was some controversy as I woke up this morning. Did not expect to see this. We've got some insider selling. We got Alexander Moore, who sold 21,000 shares. Not a big deal. 434 grand.
Sell it all.
Heather Palanshek. Wow, what a last name. Planishek. Sold 20,000 shares. No big deal. That's whatever. And then you got Shyam Sankar, our boy, our CTO of this company, selling 1.9 million shares at $20 on the dot. Pockets $40 million, and he only has 1.3 million shares left. So he sold about a third or 2/3 of his entire position. Now, on first glance, you see this and you're just like,
Holly.
before earnings. Like, this guy, what the fuck is going on? Like, what's happening? And then thankfully, for the love of God, Sham actually shared some analysis. He says, I exercised and sold 1.967 million options as a part of a scheduled 10b51 plan. This is important because if he was selling right before earnings outright, which I don't even think is legal, that would be a really bad sign. And I took all the after-tax proceeds to exercise and hold as many options as I could, which is 1.4 million. So he sells 1.96 million options. He has 1.4 million shares left after he sells all the taxes from receiving capital gains on those options. And he puts all of it, he capitalizes the word all, of the proceeds that he made after taxes into 1.4 million new shares of options. He probably got those options at like $1, $2, maybe 0.05 cents, right? These are options that he got from his 2032 plan. These forms are confusing and really need to be redesigned. So he did not make any actual profit off of these sales because he took all the proceeds and put it back into his options. Any thoughts on this, or is kind of a nothing burger?
I think a lot of people that give complaints about these sorts of things have never been awarded stocks as part of their normal compensation. If you evaluate how much tax that is that he had to incur based off of, let's just take 500,000 shares, because he went from 1.9, let's just say million shares to 1.4. Let's just say 500,000 shares times that by 20. That's $10 million. Do you think that he has $10 million sitting on the side to pay this in cash? And I would say, a lot of times people don't do their full due diligence. I get awarded shares as part of my compensation as well. And, I would have to sell a portion of them, if not more. And in fact, I think, let's just take, for example, I get awarded some of those stocks, right? Let's just say I get awarded 1,000 shares of UDOC. By the time they actually get awarded to me, sometimes I'll actually end up in the account 700. They will automatically sell a portion of them for me, which kind of sucks because, what if I wanted to, pay the taxes out of pocket, right? So sometimes companies do interesting things. It all depends on who manages the contracts, right? And who, Fidelity manages mine. And so they automatically take out, let's just say 30% of all the shares that I get awarded once they get vested to me. So, not too dissimilar for what Sham had to deal with, right? It could have been something where they automatically awarded those things to him and he ended up having to basically pay, about 25 to 30% of that in taxes. And now he reinvested that money back in. So it doesn't seem too dissimilar to me. And I think it might be confusing to those who have never really been awarded stock options before.
Well, I've never been awarded stocks, so I struggle a little bit to fully grasp the dynamics. I would say that sale actually is a bad sign from how it is looked without any way. Like, also his comment, maybe you fully grasp it, but from my point of view, I still failed to grasp. Okay, you had some options. You say you executed, but obviously you pay taxes on part, so the proceeds are less. And then I don't fully grasp. I bought and hold the most amount of options, and then you say you are long 1.4 shares. So for me, that's extremely confusing. So at the end of the day, frankly, I don't care what Sham says about his shares. I think if he had that condition at 20, to me, is a piece of information. Maybe at 20, he's that's a price he's reasonable. He wants reasonably to cut part. That's how I see it, without getting too much into the dynamics. Is this actually very worrying? I would say it's just a piece of information. If you could share the screen, please. This was from May. Our friend Chris Patel shared, CFO is selling shares on the run-up. That's
all it all. We lost you again, Arnie.
We lost you, Arnie. Your audio.
Okay. The shares were $11 per share. You can see here that the CFO basically sold half of his position close to the bottom. Like, we are 2x the price now. So if what's happening with Xiam has the same impact the CFO selling had, I would be happy with. But so the end point is
Did we lose him again? Yeah, Arnie, we lost your audio again. You're like programs. You have a ghost in your house. It's like pressing the mute button. There you
so
go.
now you're back. I think.
About these things.
Go ahead, Matt. Go ahead, Matt. Go ahead.
Okay. One of the I think people don't necessarily understand is, like, for example, let's just take, so I think the private sale price of Palantir was in the $5 to $6 range before they went public in 2020.
Yep.
So let's just say, for example, these options were awarded in 2018 or 2017, and they were going for $2 to $3 a share back then. Now they're worth $20. So he's basically sitting on, just like if you're familiar with options, he either has to exercise those, sell them, and I think he had to wait until they might have been waiting until 2030. What he might see is a good opportunity now to take the $18 per share sort of option price that he can execute, pay some taxes, buy shares. And another thing is maybe he wants to buy shares and then take leverage out against those shares, right? You probably can't leverage out against your options, but you might be able to leverage out against your shares.
Yep.
So what he might say is, okay, well, let me buy back, $1.4 million worth of shares, which is $28 million worth of shares. 1.4 million shares, which is $28 million worth of shares, whatever. And then take out, $2 million to be able to buy a house or something like that. You can't do that with options, right? So, it's part of that compensation package where, a lot of times people think that these CEOs are getting a base salary of hundreds of millions of dollars. And in reality, a lot of the times, just like Elon, people were probably saying, well, he's over here probably caking it in terms of salary. No, all of his compensation and all of his wealth came from the options contracts.
Yep.
So for him to be able to do what he did was either sell those options contracts, get awarded those shares, and then either sell them or do what he needed to do to buy Tesla. Or not buy Tesla, buy Twitter and God knows what else, right? So you have to think, like, people aren't going to award you or provide lending on options contracts. You need to have physical shares, something that's of tangible value. So another way to think about it. And then if he does it that way, he doesn't have to pay. He doesn't have to go to a bank. He doesn't have to do any of that. He's borrowing against himself, basically, and he's paying himself back. And bank, he doesn't have to.
I think that might have been Arnie. Yeah, no, I think what you were saying is a lot of sense. I think two things. We've seen Sham sell out in the open market before. I think he sold 400,000 shares a month ago, and like that wasn't scheduled. So it's like, all right, I think he sold it at $8, and it's like whatever. This was scheduled. So first of all, that takes a lot of the like concern of, oh, you're selling before earnings off the table. It was 5B1 scheduled. Number two, he was very clear. He said, after taxes, I took all of the gains and I didn't go buy a mansion. I didn't go buy a Ferrari. I bought more shares of Palantir. I bought more options, which he might have gotten a little bit even cheaper than the options he sold for, which is part of that whole compensation. I don't know the exact details of it, but the point is he went long on more shares. I think if he had clarified, and he probably wouldn't have clarified on Twitter, if he didn't go long on all of the gains he has after taxes on Palantir, that's when we can easily say, okay, he thinks at 20 it's overvalued, and that's why he's taking some money out and he's putting it into a car or whatever. If he's taking the rest of those options after taxes and putting it in Palantir at whatever price he's putting it into based on his compensation plan, even though it's $20 right now, which means if he takes even 100,000 shares, 100,000 times 20, boom, you got $2 million ready to go. Then that would be, okay, he thinks it's overvalued. That's not the case, because explicitly he says these forums are really weird, but what I did was after taxes, I took all my money and I put it back into Palantir. So this is not one of those things where you can be like, he's selling for a profit. 2 months ago when he sold at $8, he sold 50,000 shares, and we talked about it on this podcast. Yeah, he took $400,000. He probably wanted to go pay a down payment on whatever he needs to do with that money. But this is not the case. I think you're correct, Matt, that he's doing it at 20 because he's sitting on like a 10x from those options that he got at $2 or $3 probably in 2017. And he's like, this is probably the right time to exercise this, because as you said, options are worthless until they're exercised, and then you can do stuff with them. But at some point you have to exercise the
Yeah,
option.
when you get to that high level in any organization, you get options, and the board kind of says these are the thresholds you need to meet, whether that's revenue growth, whether that's EPS, whatever. And those vest over 3 years, 5 years, what have you. And so initially, when you see people come into CEO positions, it's like they'll make $1 million or $2 million. And next thing you know, people start giving them crap because then they're starting to make $15, $20 million. And it's like, okay, this is after 3 years on the job. Some of those options are starting to come through, right? And I see a lot of people give people crap about that sort of stuff, but it's like they're either meeting or not meeting the thresholds, and that's why they're getting the options, right? It's heavily based off of the stock price performance once you get to that level, not necessarily just the fact is, hey, is Matt crunching the numbers as well as he should in Foundry? All that stuff.
Yep, totally agreed. Arnie, can you say anything, or you're in the Mariana camp? Can't say anything. Can't say anything. Let's hope her speaker is good this time on earnings. I have a feeling it's still going to be shit this time. All right, that's it for us. Thank you, 375 people, for being here. Please follow Arnie and Matt on Twitter. It is in the description. It would mean the world to us if you continue to engage with our content on X or Twitter. If you don't have an X or Twitter account, you should create one. Help support Elon trying to build the next free speech thing, and follow us on the Palantir community on that platform. This is the last weekly episode before Q2 2023 earnings. This is going to be a big earnings, not for the long term of the company, but definitely to show us if AIP is where we think it can be. If customer count goes up, revenue goes down, maybe it's a dip that's really warranted for us to be able to look seriously at. Or if they blow it out the water and they say, you know what, 60% revenue growth, NVIDIA type quarter. We have no idea what's going to happen. And that's the joy of not investing in Pepsi or Costco. You're taking a chance on a growth stock, and we're going to see what management is able to do and see where it goes from here.
I have shares in Pepsi, by the way.
You do have shares in Pepsi. Of course you do. You got a bunch of options from UDoc, so that's also up.
UDoc for the win. No options, but shares. Well, currently don't own any shares. They're all restricted at the moment.
All right, everybody. Thank you. We will see you on Monday. Bye-bye. Have a good one.
Yeah.